I think they don't mind it going back into the range. The dollar index currently is about 92.3. I think the middle of the range, 96 to 98, that's acceptable. Just depends how fast it does it. It's doing it very fast that creates the problems. I always say it, pay attention to the bond market. The bond market was telling us something different. Then suddenly the dollar picked it up. And equity's always like, well, what's going on? Oh, shit, macro. The equity's always the last to figure out macro. So I think the macro outlook is changing and the market's wrongly positioned for it. But don't forget, we went into this with the biggest ever short position in the history of the dollar and one of the biggest ever short positions in the history of the bond markets. That's the magnitude. I mean, everyone's record long copper. Everyone's record long all parts of this inflation trade. And they're now talking to their risk managers going, are we going to have to cut? Now, it's happened so quick that they haven't cut risks. But this goes on next week or the week after. You'll see the equity markets reflect this volatility as well. And I love these macro knock-on effects. It's where we make all our money trading macro is understanding these kinds of linkages and when things change. The dollar moves so fast, you didn't really get a chance to do anything unless you're positioned for it in advance. Now, the big question is, does this follow through? Does those head and shoulders break? If it does, we've got a much bigger macro move to come, and there's some fun to be had because it creates volatility. So we can trade around that. We can make some money out of bonds and stuff like that. I mean, bond markets are not going to be a home run with yields at 1.4%. I mean, then you can make some money, but it's not a big trade. The dollar is pretty interesting when it moves this fast because it's a low volatility bet that's moving very fast. So that's a good risk reward. If an average move in the equity markets up or down 1%, which is actually not less these days. So this is the equivalent of a 3% move 3 days running in the S&P, basically, something like that. Yeah. So that would be a cheeky 10% off the S&P in 3 days. That's what that's the kind of VAR shock going on. But because the dollar has so many linkages, Bitcoin can move up and down, but it has very little linkages. But the dollar has all the linkages, and that's why it creates a bit of havoc. And that's why I've always called it the dollar wrecking ball. If it goes up too fast, it creates havoc everywhere. If it goes down too fast, it does the same thing. My actual view is that the central banks do not want the dollar to go much higher. There's a general dollar shortage in the world because so many people rely on dollar funding. And that issue always comes when weakness comes. People grab for dollars, and this game of musical chairs is not enough. I don't think any of the central banks want the dollar to break higher. That would be, kind of above 100, 105. If it did that, that would be a real problem for the world. We'd go back into recession. So I think they don't mind it going back into the range. The dollar index currently is about 92.3. I think the middle of the range, 96 to 98. That's acceptable. Just depends how fast it does it. It's doing it very fast that creates the problems. Yes, because I think that we have a unknown structural unemployment issue with the labour force participation rate endlessly falling. And it's something I talked about with Ed last week, is the inflation. We don't know what the natural rate of unemployment is now, because of the restructuring of Main Street with many retail closing down, etc., and a restructuring of the economy post-COVID. So if that's the case, then governments are going to have to find ways of helping those people. And governments have been looking for an ability to use fiscal stimulus to both A, win votes because they're politicians, but B, to drive the green agenda and to overhaul the global infrastructure. And the real issue is because global GDP trend rate keeps falling. So they need to try and change the structure of the global economy, but debt and demographics keep getting in the way. So they're going to spend a lot of money. To me, it's much like the post-World War II era, when we had massive fiscal stimulus to try and retool the global economy. It wasn't actually that inflationary in the end, but what it did do was actually create tons of innovation and growth. And I think that's what's the outcome here. But it's going to be a huge transition for the global economy, and that the ECB, the Fed, the BOJ, everybody is looking for an excuse to hit the fiscal stimulus button. And the central banks have kind of said, don't worry, we've got your back. Because either we impose yield curve control, which means we'll buy unlimited amounts of bonds at a fixed price, so yields don't rise and you don't have a problem funding your deficits, or if not, we'll undertake more QE and buy these bonds anyway. So it feels like the government, and much like in Japan, the government and the central bank are now the same thing. The exponential age thesis is a new macro framework that says macro's normally about buying the puts, where you make the money when the economy turns down, like we've been talking about now. You go long the dollar, you buy bonds, and you buy puts on equities, and you make a fortune in short periods of time, and then you eke out returns over other periods of time by maybe owning emerging markets or other things. That's generally how macro's always worked. So it's very lumpy returns. But we're going to an age where what is the downside in equities? Because if equities fall, the central bank stimulates. If they stimulate, you lower the denominator and they get repriced higher again. And we saw that after the biggest recession in all recorded history. The equity market screamed higher, went down for a month, and that was it. Everyone's like, whoa. It's because they lowered the value of the denominator, fiat currency overall. So we know that basically in a situation where any growth is weaker, the central bank prints, and therefore equities go up. If equities fall, the central bank prints and equities go up. If inflation rises, the central bank caps yields and ends up buying all the bonds, which is the expansion of the balance sheet, equities go up.
Yeah.
So the only time they go down is VAR shocks. So that's a value at risk shock. That's when something else blows up like the dollar and equities panic. But again, the Fed's got your back. I know this sounds crazy. Everybody hates it. It is what it is. And I didn't want to believe this was true, but I now believe it to be true. And in that environment, you want to own the things that go up the most, and those are the businesses that have exponential charts because they're driven by network effects. So that's the network effect that we see in Bitcoin, that we've seen in all FANG stocks. Facebook is a classic network effect stock. So those things do really well in this kind of environment because they're groundbreaking technologies that are taking new adoption. Facebook, for example, is going to pivot towards VR plus crypto as it brings Facebook DM, and it's also buying up most of the VR world. So Facebook's going to play a big role in the future. Apple is doing the same with AR, and all this other stuff is going on. So these companies are repositioning for the next S-curve higher, the next exponential adoption of technologies. They're all coming, but that's also against a backdrop of the adoption of artificial intelligence, distributed computing, autonomous vehicles, electric voltaic vehicles, green energy, robotics, genetic sciences. All of these things are not now pie in the sky futurist stuff. They're things happening right now and are getting adoption in front of our eyes. If you want to see adoption, see Ethereum and what's going on there. That's mass adoption of technology. So these things are all happening at the same time. They give exponential upside rewards. So in this environment where the Fed's got your back on the downside and the upside's exponential, you want to be long the upside and not looking to trade the cheeky downside, macro bet. This is the macro bet that we're transitioning into a different world. And a lot of people are very cynical of that because they don't know how to value these things. But once you understand, just use a logarithmic chart and look at the adoption of that network and the growth of the network and the number of connections that are being built in the network, then you understand everything and it all becomes clear. Well, generally these exponential age, these things with network effects where we don't value so much off cash flow, you kind of think of them as super long-term bonds. So therefore, super long-term bonds go up enormously as yields fall.
Right.
And that's how these things traded all the way through the COVID experience, because they're not cash flow constrained, because they just produce margin and cash flow. They're like machines, these things, extraordinary. So that makes them very attractive in times of economic slowdowns or economic uncertainty. So that doesn't mean you won't get volatility in them, but they tend to do extremely well indeed. So FANG stocks massively outperformed all other stocks last year. And I think that kind of environment plays out again. So I'm looking at that. Bitcoin, on the other hand, really is a play on central bank balance sheets and the adoption of the technology. So the adoption of technology goes relentlessly forwards. There's been less retail activity because of the sell-off and some of the Chinese issues, and the ESG narrative has slowed the buying down, so the market's been pretty heavy as Chinese miners have offloaded some of their inventory because some of them are closing up shop or having to move location, and that's weighed down. We see that Grayscale Trust hasn't been buying much Bitcoin recently, but over time, if I'm right and the narrative shifts towards, you know what, we need to print more money again, then Bitcoin's going exponential, because everybody understands that Bitcoin is the best asset in the world to own in a re-expansion of the balance sheet.